Some people pick stocks like they pick Netflix shows, random, impulsive, and based entirely on the thumbnail. That's fine for binge-watching reality TV, but if your portfolio is built the same way, your retirement plan might be called living in your nephew's basement. Today, I'm giving you the 16-point checklist that separates the smart investors from the ones Googling what is a margin call at 3 a.m. Let's turn you into a stock-sifting, profit-sniffing machine. 1. Industry. If the industry is sinking faster than Blockbuster in 2010, don't expect the stock to float. You want a space that's growing and has room for more players. Example, electric vehicles, Tesla, growing market, consumer demand, future regulation trends. It's like surfing a wave instead of paddling in a kiddie pool. All right, you found a hot industry, but picking the wrong company inside it is like joining a winning sports team and still being the bench warmer. Let's look under the hood. 2, business model. How does the company actually make money? Subscriptions? Ads? Selling overpriced coffee with your name spelled wrong? Example, Netflix. Recurring subscription revenue. Investors love recurring cash flow, like TikTok loves dance trends. Cool business model, but is it actually working? Let's check the receipts, literally. 3, historical growth. Past growth isn't a guarantee, but it's a good sign. Look for consistent revenue and earnings growth, not one lucky year. Example, Apple, AAPL, year-over-year revenue growth, driven by iPhones, services, and wearables. Nice growth, but has that growth made anyone rich? Let's find out. 4, historical value creation. Has the stock created shareholder value? Think total returns, dividends, and stock buybacks. Example, Microsoft, 2 huge returns since Satya Nadella took over in 2014, plus steady buybacks. Okay, it's creating value. But why this company and not the hundreds of others? 5, moat. What makes it hard for competitors to copy? A strong brand, patents, network effects, or economies of scale. Example, Coca-Cola brand moat so strong you could blindfold someone and they'd still recognize the taste. A moat keeps out invaders, but what's inside the castle? Let's check the cost of running the place. 6, capital intensity. If a business eats cash faster than you eat chips during Netflix binges, be careful. Low capital intensity means more free cash flow. Example, vis-a-vis scalable, asset-light business. Cash hungry or cash rich? The next question is, are they actually making money? 7, profitability. High margins, strong earnings, and healthy cash flow are non-negotiable. Example, Alphabet and Google, sky-high margins thanks to advertising dominance. Strong profits? Great. But are they financially ripped or running on credit? 8, balance sheet. A strong balance sheet means manageable debt and plenty of cash. Example, Johnson & Johnson J&J, AAA credit rating, low debt-to-equity ratio, solid balance sheet, but are they rewarding you for sticking around? 9, capital return, dividends, share buybacks, anything that hands money back to investors. Example, Procter & Gamble, dividend king with 67 plus years of consecutive increases. Getting cash is nice, but who's actually steering the ship? 10, management. Do they own stock themselves? Are they competent? Or do they just collect bonuses while the ship sinks? Example, Berkshire Hathaway. Warren Buffett eats his own cooking, owns a huge stake. Even with good captains, how they spend the treasure matters. 11, capital allocation. How well do they reinvest profits? Look for returns above the cost of capital. Example, Apple. Massive RD plus stock buybacks, delivering huge shareholder value. Smart spending is great, unless they start giving away the store to employees. 12, stock-based compensation. Too much SBC can dilute your shares. Example, Meta. Heavy SBC in past years. Investors watch closely. All right, we know the numbers, but where's this company headed? 13, outlook, future growth projections, and whether they're realistic or pure hype. Example, NVIDIA, riding the AI wave, but with fundamentals to back it. Growth is nice, but can they adapt when the market changes? 14, optionality. Can the company launch new products or enter new markets successfully. Example, Amazon went from books to cloud computing to, well, everything. Of course, every castle has weak points. 15. Risks. Every investment has risks: regulation, competition, or reliance on one big customer. Example, Boeing. Operational and regulatory risks impacting stock performance. Now, the question, is it worth the price tag? 16. Valuation. Is the stock undervalued, fairly valued, or overvalued based on metrics like P/E/P/S or discounted cash flow? Example, at the start of 2023, Meta was trading at a deep discount compared to growth potential. So there you have it, the ultimate 16-point X-ray for any stock. Use this and you'll stop gambling in the market and start investing with intention. If you found this useful, hit that like button so the algorithm knows you're not here for cat videos. And subscribe for more sharp, sarcastic, and slightly addictive finance content. Now, go analyze something before your money analyzes itself right out of your account.